Here we go again. I have a macro data for this week that tells you how to diversify and why. But before that, let's see what happened this week so far. I'm Thomas, and in this video I will cover what to expect from the latest macroeconomic data releases. This week, the depressive mood in the banking sector has decreased as more and more banks are buying each other, just as First Citizen Bank is doing with Silicon Valley. First Citizen Bank, forever first. But we also had the move by the UBS to bring Sergio Ermotti back for the integration of Credit Suisse. In addition, media news is flooding in that Nasdaq is in a new bull trend as if there were no tomorrow, no bank crisis, and no total economic crisis. We just look forward, not backward. Apple has also launched the buy now, pay later services, which was urgently and indispensably needed. Mostly because nobody pays for the product anymore, so they don't charge interest on the loan as long as it's paid on time. The question will be, if there is a credit crisis coming, what will happen with this service? It's a train many people have gotten on, and as long as it's going, you have to get on too. But sometimes look out the window to see if there is still a track ahead. If not, it's better to jump. And Hungary has accepted Finland's NATO membership request, and with this, we have successfully further pulled the bear's whiskers, which is, moreover, really about to wake up from its winter sleep soon. Finland could become a potential base for American nuclear weapons, and everyone can draw the possible consequences from that. So everything is good, everything is beautiful. There is absolutely no problem in the world, so the markets are soaring as there has never been such a stable economy and world peace before. Therefore, we are moving to Monday and will be so much very important data. For example, Swiss CPI, final manufacturing PMI, UK manufacturing PMI, OPEC meeting, which is very important for oil lovers, Canadian manufacturing PMI, ISM manufacturing PMI from the United States, and also the world's total vehicle sales. Unfortunately, I can't tell you all the details in this video because there is so much I want to tell you. So if you're wondering what other data is important and why, then you definitely should visit our website and sign up for the Pro membership, because there is where you will find these information. But for now, we're going to take a look at this piece. The United Kingdom's producer data is more interesting than the European Union's data. In the last weekend video, I mentioned that the UK cannot slow down its economy to the same extent as elsewhere because the complex and costly export-import caused by the Brexit requires the economy to run to some extent for supply assurance. As a result, it is already aggressively on the rise, leading to an increase in the UK's CPI as well. Above 50 points, we can talk about a fairly active economy, which means that producers are hoping for profits from their performance. And this is a problem. This could mean that the Bank of England is counting on inflation for a very long time, which could even turn into stagflation. Besides how much this will hurt people, we see signs that the Bank of England may be giving up the fight considering the recent 25 basis point interest rate hike. This is the same as in the United States, but the British are in a much tighter situation, so I believe this was not enough for them. Therefore, it's no secret that I'm eagerly awaiting for this PMI data. In case of an increase, the British pound may strengthen in the hope of possibly rising GDP, but later, the potential rising CPI data may counterbalance it after some time. And here is a second very important data. In the United States, the importance and significance of the PMI data are now almost equal to the situation in the European Union. Stagnation is expected with a boundary value of 43 points in case of harmful decline, while above 50, the inflationary risk posed by an active economy can also be started. However, there is still a difference in that the US dollar is currently in negative territory, so consolidating or slightly declining PMI would support the decline, while in case of an increase, but still below 50 points, there would not be a significant impact. Or wouldn't? Because we are about to get non-farm data as well, which could change the whole picture very, very fast on Friday. Now, unfortunately, I don't have too much time to talk about the world total vehicle sales, but as I said, you will find on the Discord server after you sign up for the Pro membership. Right into Tuesday, we're going to get cash rate from Australia and the JOLTS job openings from the United States. This is what we take a look now. Needless to say, it can be seen from the chart that we cannot talk about increased job openings since mid-2021. We can talk about stagnant numbers, which could be considered high, but the lack of growth is caused by slowing production and economic growth. I expect this number to decline in the next months ahead. We don't know from the market's perspective when and which recession indicator will be the breaking point for investors. It could be related to real estate market, loans, unemployment data, or job opening data. Looking at the shorter term, the average number for the last 9 months is already bending downwards despite some improvement since October 2022. However, the improvement is very mild, but the previous low point provided a good reference for the possibility that a return to 10.06 million could be the smoking gun, especially if accompanied by rising CPI, rising unemployment, and falling GDP data. And be aware the forecast is already 10.49 million, which is almost 0.4 million less than previous data. So we don't know what will be the actual, but it's pretty dangerous. Now, going to Wednesday, this will be very interesting. We're going to get New Zealand official cash rate, final services PMI from the European Union and the UK, and United States data like ADP non-farm employment change, ISM services PMI, and crude oil inventories, which will be very important for oil lovers. Don't forget, previously there was some OPEC meeting at the beginning of the week, so this could move a little bit the oil prices. But we're going to talk about this on the Discord server and have a look. What is the data, what I mentioned to you, that actually shows you how to diversify your capital and why? Now, this data must be understood together with the UK data. So in today's update, I will dive into an interesting economic phenomenon that's been unfolding in the European Union and the United Kingdom. It seems that we are witnessing an interesting divergence between the services and the manufacturing sectors. The Purchasing Managers Index for services has been on the rise, while the manufacturing PMI has lingered below the 50 points threshold for quite some time. Let's dive in to understand the implications of this trend and why it matters to you as an investor or trader. At first glance, the increasing services PMI may seem like a positive development for the overall economy. It suggests that the services sector is expanding, which typically indicates strong consumer demand and healthy economic growth. However, when juxtaposed with the persistently low manufacturing PMI, this paints a more complex picture. The manufacturing sector appears to be struggling, with the sub-50 PMI signaling contraction. This is a result of various factors such as a supply chain disruption, we talked about that earlier, labor shortages, usually one of the causes, but it is not yet experienced at the required level. But don't worry, on its way, don't panic. And weak global demand for manufactured goods as a result of slow economy, indicated by the rate hikes and high inflation. While the services sector continues to thrive, a prolonged weakness in manufacturing can have a significant ripple effect throughout the economy. So until the market does not show another massive sell-off, services still perform well due to low manufacturing need to run the businesses and, of course, the pre-recession fear hype. So what does this mean for you as an investor or trader? First, this situation highlights the importance of diversification of your capital. As some industries or sectors may outperform others, a well-balanced mix of assets can help mitigate risk and potentially benefit from the varying performance of different segments of the economy. But this time, we know exactly what is coming. So the diversification is not about where to keep my money for long term anymore, but where to diversify until any full market sell-off. So swing trade instead of investing, or complete hedge against a position that is intended to keep over even under a storm, regardless that the reason for doing this, keeping open that position, is a business decision or investment decision. And the winner is certainly the services sector. So as long as the services PMI can rise or be above 50, there is still revenue made by this sector. But don't forget, not all companies. So Keeping a close eye on this economic indicator can help you identify potential opportunities and challenges in the market. For instance, businesses in the services sector may continue to flourish, while those heavily reliant on manufacturing might face headwinds. In conclusion, the diverging PMI trends in the EU and the UK may seem perplexing at first, but a deeper analysis can reveal valuable insights and help to choose the right strategies, as I just mentioned. So to think what you need to really keep an eye on. As long as the data is above 50, the services sector is very healthy. I mean, as much very healthy as it can be in this environment. But don't forget, military and defense sector can be very strong in services. So as long as this data is positive, military and defense services are the winners probably for this environment. And as I pointed out last month, this data serves as a forecast for the upcoming non-farm data, so the market follows it with extreme manifestation, as it allows for conclusions to be drawn about Friday's figures. Employment has technically barely changed since May 2022, which is not surprising given the economic slowdown. There have been occasional large data movement during this period, but the values we received are negligible. However, we are already experiencing a mild increase of unemployment and slightly decreasing new job numbers, so we will primarily focus on any outstanding values, in addition to the fact that the market will have an aggressive reaction to them anyway. Let's not forget that we are now expecting fuse-like data, and this could be one of them if we drastically approach zero or the value falls below it. A significant increase could also trigger a drastically aggressive reaction, but this is currently less likely. More likely that the forecast shows 208k, which is a significant drop after 242k. So with this data, if it comes true, we will be very heavily closing in to zero, which is a big problem for us now. Now let's move to Thursday, because that will be a very interesting day as well. We're going to have Canadian employment change, unemployment rate, United States unemployment claims, and Canadian IVA PMI. Now I want to talk about all of them, but today I can only in this video about the IVA PMI. The Canadian Purchasing Manager Index measures the activity of purchasing managers in the manufacturing and non-manufacturing sectors in Canada. It is published monthly by the IVA Business School and Western University. A PMI reading above 50 indicates that the sector is expanding, while a reading below 50 suggests contraction. Very similarly to the ISM data from the United States regarding the point system. And this can influence the value of the Canadian dollar, so the CXY. The Canadian economy is facing several challenges such as supply chain disruption, still since COVID, slowing GDP growth, global bank liquidity issues, a struggling manufacturing sector, and high inflation. In this context, the IVA PMI's movement could have some effect on the CXY seriously on that day. Regarding a reading below 50 would indicate that the Canadian economy is still contracting regardless of the last two slightly positive data. This may lead to a negative sentiment among investors and foreign banks, which could weaken the CXY. The central bank might be prompted to reconsider its interest rate policy to stimulate growth, but that would depend on their assessment of the inflation situation, which is obviously not too good. So a war could solve a lot of issues later on, as military spending is always the last solution. It worked 2 times at least, and both had worldwide effects, unfortunately. A reading above 60 indicates some expansion in the economy after the last 2 slightly positive readings, which could boost investors' confidence and strengthen the CXY if the DXY remains under pressure. In this case, the central bank might continue with its interest rate hikes to tackle inflation, as the economic growth could offset some of the negative impacts of the rate increases. But it's important to note that currency movements depend on a variety of factors, and the IVA PMI is just one of the many indicators that can influence the CXY. And here we go again, the usual month-starting bloodbath. I need no extra information to share for this event. You all already know the schedule. Don't forget, the first 15 minutes move isn't the final direction at 99% of the times. So get ready for some popcorns. I will do so definitely. Mainly because employment is expected to drop significantly according to the forecast, and this could have a serious impact on investors' attitude. So the figure is expected to fall from 311k to 235k, which is a drastic decline, and it could bring substantial volume on Friday. So it seems there is some negative data for Friday. There could be surprises, but in reality, this is exactly the direction we have been heading so far. Amid the misconceptions associated with money printing and the buy-the-dip euphoria, the real facts are taking shape in the background, and if we remove these noises, we can clearly see that the Fed is sticking to its plan. No rate cuts have occurred, as it was never planned even once, and although the banking sector is in crisis, global crisis, it hasn't collapsed yet. However, increasing unemployment figures, declining employment, flat GDP are already coming, but there is only one real danger, and that is the rise of inflation. And just as before, the Fed will take further steps against it. And of course, we will reach the pivot point eventually, which will be painful, but after that, the money printing can truly begin. Traders therefore hope and count on betting against the Fed, as has happened many times throughout the history, and this battle against windmills has so far not been able to show a positive balance for long-term thinkers. However, if we understand the workings of the market and accept it for what it is, we can remain profitable in this environment. This week, the stock market closed entirely in green, thanks to the buy-the-dip pink cloud, which is not a problem in itself. Knowing that the dark clouds are gathering does not mean not taking actions. So, in most places, there were good catches on the Discord server, such as in the case of the US 30. Of course, only on low time frames, so the profit units land in the pocket instead of the hope that the price might not fall. One advantage of intraday trading is that there is no need for hope, just realizing profits, and as long as the train goes, we get on it. The essence is that while the momentum is justifiable on higher time frames as well, moving to a lower one, we determine the possible breakout points, and in case of a breakout, we exploit the movement until the next resistance. Therefore, we reach the movement seen on the chart by focusing between two resistances on higher time frames after verifying the presence of momentum, as breakouts always provide stable momentum on low time frames. In the case of a 5-minute time frame, the first white zone is the no trade or no-go zone due to the uncertainty of consolidation. This was followed by a red false trade zone, which could have led to losing trade, but with the usage of the 2 per 1 and 2% rules, you can find it on the Discord server by the way, this loss was absolutely controlled. Not surprisingly, consolidating movement followed this as well, which was also no trade zone, and it was still questionable whether the price would have enough strength to continue. But the breakout occurred with proven high momentum, so trades were activated, followed by a correction that put us back into the no-trade zone. The 32,926 level had this larger uncertain movement structure, but we could continue the post-breakout trades, and the flag sent an appropriate signal for the possibility of continuing the rise in the last part of the day. Each position could be held on average for 3 hours without much stress, and the position closures realize the profit, which is therefore not endangered in case of a potential negative open next day. At the same time, we can get back on the train next time as well if we can still verify the momentum. There is, however, an anomaly in the crypto market. This week we experienced that Binance trading volume completely disappeared from the Bitcoin chart. We have already discussed the possible reasons for this earlier. One possible cause is the withdrawal of BTC to cold wallets, leaving no active trading in the market. This scenario would be bad news for those who hope for significant increase in price without crypto capital inflow. At the same time, 510k volume has dropped out, which is a drastic amount. And this anomaly is not explained by the fact that Binance provides fee-free trading with TUSD. Although there is a significant increase in the TUSD chart in the middle, if someone looks a little behind the scenes, we'll quickly realize that the average increase is 27 key, which is nowhere near to the missing 510 key. And the Binance US does not experience any significant volume change on the right side. This raises further question about whether the total market cap will be able to break the critical zone between 1.12 and 1.26, which it will struggle for the third week. It will be difficult without volume. That means either the tight tokens need to be released or capital from external sources is needed, and this depends on how much other markets and the Fed tighten their belts. There is not much good news in this regard. As the money supply decreases, so does the possibility of increasing capital. Perhaps this is also the reason why the crypto market has performed very mixed this week, with the expectation of one or two extreme moves. There is no outstanding value and a clearly bullish market, but rather we have been trending water for a long time. This could bring back the dominance of the DXY. So in terms of macro data, everything that could have a significant impact on DXY next week should be monitored, and there will be no shortage of this, as I mentioned you throughout the week. Well, if you're wondering how we're doing our business on shorter timeframes, crypto market, forex market, and the stock market, visit our website and visit the pro level. And I hope that the information was useful for you. Remember, at the pro level, we analyze every major macro data and draw the proper conclusions when they arrive. If you want to join, link in the description. In the meantime, I would love to hear your thoughts and opinions in the comment section. If you want to stay informed about next week's data and other useful information, subscribe and turn on all notifications. And if you enjoyed the video, give us a thumbs up so it can reach more people. Until then, see you in the next video.